When couples divorce and begin dividing their property, some assets are simply more complicated than others. And although getting an accurate value of every asset is critical, and many have their own set of complications, in this video, I'm going to speak about one type of asset in particular, and that is insurance products, specifically permanent life insurance and annuities. Stay tuned. Finances and divorce, valuing insurance products, coming up. Drayton, Certified Financial Planner Professional, Certified Divorce Financial Analyst, and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, go ahead and subscribe. And if you're viewing this from the blog page of my website, fill out the contact form at the top of that blog page so you can join those who receive notification when new content becomes available. Recently, I did a video speaking on the topic of the division of assets in a divorce, the subtitle of which was, "Not All Assets Are Created Equal." In it, I spoke about the many aspects that need to be considered when valuing each particular holding or account that a couple may have. Frequently, different types of accounts or retirement plans have unique rules or tax treatment, and therefore, to determine the actual value of those assets, that tax treatment needs to be considered. But in today's video, I'm going to speak about a specific asset type, and that is permanent life insurance and annuities. These are insurance products that many people have which have their own set of complications. And these are not necessarily tied to tax treatment, but are more a function of fairly common provisions that many, actually most, of these products contain. So first up, when you own a life insurance policy or an annuity, what is it specifically that you own? Well, what you have is a contract, and it is a contract between you and whichever insurance company from whom you purchased this product. This contract has provisions and obligations. Just as there are a large number of insurance companies, there are a large number of features, provisions, and obligations that one will find in these companies' insurance contracts. However, the good news is many are quite common within the insurance industry and across their various products. Of course, when couples are divorcing and dividing their assets, the most important question will be, what is this contract or product worth? I'm going to start with life insurance policies, and here, when you look at the life insurance policy statement or illustration, you're likely going to see a number of values. First and foremost, you'll probably see the face value of the policy. This, of course, is the death benefit, the amount that will be paid to the beneficiary if the person whose life is insured by the policy dies. This is not the value of the policy. When property is being divided between spouses, they're going to want to know what the policy is worth now at the point of their division. Again, the face value or death benefit only gets paid at the time that the person whose life is insured dies. Another value is the cash value, and sometimes this is identified as the value of the policy when dividing assets. However, like face value, it is not. Cash value is significant and likely will be the value that the insurance company uses to determine interest or investment returns that will be added to the value of the policy when those returns are calculated and credited. However, it is very possibly not the value that one would receive should they decide to immediately surrender that policy for cash. That value is the surrender value, and it is the surrender value that should be used to determine the true value of the policy at the point in time that assets are being valued and determined. Now you might wonder, why is it that cash value is not the same as the surrender value? Well, when insurance companies sell their products, and this is true for both permanent life insurance policies as well as annuities, they incur a number of expenses at the point that the contract is issued. For example, in the case of a life insurance policy, they may have paid for a paramedical exam to determine the insurability of the person being covered. However, for both life insurance and annuities, insurance companies typically will have paid their representative, financial associate, or something similar, a commission to have represented and sold their product. These commissions are not insignificant. Over time, the insurance company will recoup these expenses from the fees that are contained within the policy or annuity. However, to protect themselves in the event that a policy or contract holder will want to cash out before the company has recouped their expenses, there will likely be a surrender charge schedule that imposes a fee on the purchaser of that contract in the early years of their ownership. And early years can be as long as a decade. So a couple of takeaways. If one of the pieces of marital property that you are going to be receiving when you and your soon-to-be ex-spouse are dividing assets is an insurance product, such as a life insurance policy or annuity, the value that you are going to want to know for that contract is not the face value, not the cash value, but the surrender value on the date that this asset is being valued. This is always important, but will be especially critical if this asset has been owned for a decade or less. One other word of caution with regard to the valuation of insurance product assets. Contributions to these types of assets are made in the form of premium payments. In the case of a permanent life insurance policy, these premiums will add to both the cash and surrender value of the policy, but they also pay for the cost of the life insurance itself. Therefore, if there's an interruption in the payment of these premiums, that cost of insurance is going to start coming from the cash value and devalue what one would receive should they choose to surrender that policy. Since the divorce process will likely take months, possibly years, if you are going to receive an insurance product that you did not own prior to the division of you and your spouse's property, you will want to make sure that any premiums that were due during that interim were being paid. Especially critical if the account from which these contract premiums were being made was not an account on which you had good visibility during those intervening months. If you or someone you know is going through a divorce, I highly recommend that you seek the counsel of a qualified family law attorney in your area. Additionally, for advice regarding the financial aspects of your divorce, I would look for a financial professional who has the letters CDFA, or Certified Divorce Financial Analyst, and CFP, or Certified Financial Planner, following his or her name. These designations mean different things, but ideally, I would look for a professional who has both. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only. Not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.